Welcome, deep divers. We're kicking off today with a special invitation for you. If you find this deep dive valuable, we'd love it if you'd like and subscribe to the Stock Analytics AI YouTube channel right now. Yeah, for just $4.99 a month, members get priority deep dives on the tickers you request. So if there's a company you're curious about, well, you know where to go. Today, we're peeling back the layers on D-Wave Quantum Inc., trading under the ticker QBTS. This is a company operating at the absolute bleeding edge of quantum computing. We're going to unpack its pioneering technology, its current financial health, and the really volatile market sentiment surrounding it. We'll even look at it through the lens of a Warren Buffett-inspired analysis, and I can tell you, the conclusion is going to tease out some pretty fascinating contrasts, between pure innovation and traditional value investing.
Right, and what's truly fascinating here, I think, is that D-Wave presents such a complex picture. It's very much a high-risk, high-reward investment proposition. It's really not a classic value play in the Buffett sense. We'll explore why its innovative technology is so exciting, definitely, but also why its financial profile and, frankly, its ongoing challenges make it a truly speculative venture right now. So our mission in this deep dive is really to equip you with the essential knowledge so you're well-informed on this groundbreaking yet pretty controversial company.
Okay, let's unpack this then. Our journey into D-Wave Quantum begins with Chapter 1, Business Understanding.
Okay, so D-Wave is, well, they're a recognized trailblazer, known as the world's first commercial supplier of quantum computers. What makes them particularly unique, I'd say, is their dual-track approach. They're actively building both quantum annealing architectures, which are fantastic for solving very specific, complex optimization problems, logistics, or drug discovery, and also gate model quantum architectures, which is, the more general purpose approach, the one aiming to be a universal quantum computer eventually.
So how does this cutting-edge company actually make money today? What's the revenue model look like?
Well, they have a, multifaceted revenue stream. It comes from direct sales of their powerful quantum computing systems, like the Advantage system. And that system, by the way, saw its initial sale drive a record $15 million in revenue in Q1 2025. That was a substantial 509% increase year over year. Huge jump.
Yeah, 509%.
Yeah. They also generate revenue from subscriptions to their cloud-based LIPA service and licensing their proprietary software like the Ocean SDK. This combination, the idea is to sort of democratize access to advanced computing for businesses.
And where do they stand in this emerging market? It feels crowded already.
It does. D-Wave holds, I think, a unique position by focusing on delivering tangible commercial systems today. That really differentiates them from many competitors who are still focused on, let's say, earlier stage prototypes. They boast a growing customer base, 133 clients in the last 4 quarters, including 69 commercial customers, and nearly 40% of those are from the Forbes Global 2000, so big names.
Like who? Like any examples?
Sure. Notable users include NEC, Volkswagen, Lockheed Martin, and their new Advantage 2 system. They've even demonstrated it solving a materials simulation problem 25,000 times faster than classical supercomputers. That's a claim of quantum supremacy, basically meaning it did something a classical machine couldn't practically do.
Okay, that sounds impressive. But how does their size compare?
Right, well, their market capitalization is around $4.83 billion currently. That's smaller than some competitors like IonQ, which tops $9 billion. So they're not the biggest player by market cap.
Got it. So what's their core value proposition for you, the customer? What's the pitch?
It's really all about delivering practical quantum computing for real-world, in-production applications today. That's their line. They emphasize immediate, real-time access through their Leap Cloud platform, helping businesses tackle problems that, well, even the most powerful classical systems just can't handle efficiently.
And if we connect this to the bigger picture, what does the quantum computing industry itself look like right now? Is it really taking off?
Oh, absolutely. The global quantum computing market is experiencing unprecedented growth. It was estimated at about $1.79 billion in 2025, and it's projected to grow at a robust compound annual growth rate, 31.64%, to reach $7.08 billion by 2030.
31% CAGR. It's huge.
It is. This expansion is fueled by significant government investments worldwide and just increasing demand for solutions in fields like AI, cryptography, drug discovery. The list goes on.
But it's a fiercely competitive field, right? You mentioned others.
Absolutely.
Yeah.
Fiercely competitive. Major tech giants like IBM, Google, Microsoft, Amazon, they're all heavily invested.
Yeah, the usual suspects.
Exactly. D-Wave tries to differentiate itself through that dual architecture approach, and its focus on immediate commercial viability, selling systems now. However, some industry observers, it has to be said, view their specialization in quantum annealing as maybe a niche, or even, some say, a commercial dead end compared to the general-purpose gate model architectures that most leading competitors are pursuing. It's a key point of contention, really.
Okay. And what makes it so hard for new players to just jump in? What are the barriers to entry?
Oh, the barriers are significant across the board, technologically. Quantum systems are incredibly fragile, very error-prone. They require immense continuous R&D just to keep them stable and improve them. Financially, the costs are just incredibly high. Billions have already been invested globally, and you need deep pockets. And then there's the human capital side. There's a severe scarcity of highly skilled quantum physicists and engineers. It's hard to find the talent.
Given all this, what about D-Wave's competitive advantages? Thinking through that Buffett lens again, what's their economic moat, if they have one?
Well, they definitely have notable brand strength. Being a pioneer, the first commercial supplier, that counts for something. They also hold one of the largest quantum IP portfolios in the industry, over 210 issued U.S. patents. That's significant protection. And while they achieved that record GAAP gross profit of $13.9 million in Q1 2025 with a very impressive 92.5% margin, it's really crucial to remember that was largely due to a single system sale.
Right, that one big sale.
Exactly. Sustaining that kind of margin and profit consistently is the real challenge for them.
Buffett often looks for an unassailable moat. While D-Wave certainly has an impressive patent portfolio, how durable is that moat in such a rapidly evolving, bleeding-edge field? I mean, the tech itself is still maturing so fast. Also, could their Leap Cloud platform create a kind of network effect? Where more users mean more value for everyone, like a virtuous cycle.
That's a great question about the moat's durability. And you're right, while the patents are strong, the fundamental nature of quantum technology is still shifting so rapidly. It constantly challenges any notion of an unassailable position. But yes, their Leap Cloud platform absolutely has the potential to create a powerful network effect. As more users develop applications, share insights, the platform inherently becomes more valuable for everyone using it. That's the theory. And there are indeed substantial switching costs for customers. We're talking estimates between maybe $500,000 to $1.5 million per project.
Wow, that's high.
It is. That's mainly due to the extensive retraining of staff and the system recalibration required if you want to move to a different quantum provider. It's not a simple switch.
Okay, let's move on to Chapter 2, Management Evaluation. And you said earlier, here's where it gets really interesting.
Yeah, I think so. The company's leadership is anchored by CEO Dr. Alan Baratz. He took the role in 2020. He brings, over 2 decades of experience in product development, market introduction. He was actually the first president of JavaSoft at Sun Microsystems back in the day.
Oh, interesting background.
Definitely.
Wow.
And under his leadership, D-Wave did report those record revenue and gross profit numbers in Q1 2025 we talked about.
Okay, but how has management handled crises? Especially with a stock that has seen some, dramatic swings.
Yeah, they've definitely faced significant challenges. There was that 8.86% stock price collapse on April 28th, 2025. Factors cited included things like China's rare earth mineral export ban, but also just persistent concerns about their financial fragility. In response, they've been pretty aggressive in raising capital through equity offerings. Like they raised $146.2 million in Q1 2025 and then announced a new $400 million stock sales agreement in June 2025.
That's a lot of capital raising.
It is. And while these moves provide crucial liquidity, cash to operate, they also result in dilution for existing shareholders.
Explain dilution quickly for us.
Sure. It essentially means your slice of the company pie gets smaller because there are now more slices, more shares outstanding overall. Each share represents a smaller percentage of the company.
Got it. Now, this raises an important question, especially for investors, given the volatility and maybe some of the claims. What about the management team's ethical reputation?
Right. And D-Wave's ethical reputation has indeed recently come under scrutiny. This is a big point. Both the Portnoy law firm and the Shell law firm have initiated investigations into D-Wave Quantum Inc. for possible securities fraud.
Securities fraud. That sounds serious.
It is. These investigations largely stem from a pretty critical report by Carisdale Capital, who are a well-known short seller. And their report raises serious concerns about the credibility of D-Wave's technology itself. The report alleges, for instance, that D-Wave's technology is primarily just a marketing strategy, that it lacks a viable roadmap for gate-based quantum computing, which most competitors are focused on. It even alleges that much of its current technology relies predominantly on classical computing methods, not truly quantum.
Wow. So questioning the core tech.
Yes. Carousel Capital also characterizes quantum annealing D-Wave's main focus as that niche offshoot, largely abandoned by the rest of the industry. And they assert that D-Wave's quantum supremacy claim is commercially overstated and that the company might have alienated parts of the scientific community through what Carousel calls aggressive marketing claims.
Okay, that's quite a list of allegations.
It is, and it's really important for you, the listener, to know that these are allegations at this stage. The outcomes of these investigations will be absolutely crucial in determining public perception of the company's integrity, its technology, and its future.
Definitely something to watch closely. So, given all that capital they've raised, are they using it effectively to actually grow shareholder value?
Well, that's the million-dollar question, or rather the billion-dollar question here. Currently, their return on invested capital, ROIC, is deeply negative. We're talking negative 45.13%.
Minus 45%.
Minus 45%, which is significantly lower than their weighted average cost of capital, or WACC, which is around 9.44%. So this isn't just failing to generate returns on the money invested. It actually indicates that the company is actively destroying value for every dollar invested, according to this metric.
That doesn't sound sustainable.
It isn't, not without constant external funding, which, as we just discussed, brings its own risks, like dilution. Now, they are heavily investing in R&D. Operating expenses were up 31% to $25.2 million in Q1 2025, largely for developing new systems like Advantage 2. And they have no history of share buybacks or dividends. They're clearly prioritizing reinvestment over direct shareholder returns. That's common for early-stage tech.
Right.
But that deeply negative ROIC really raises serious concerns about whether that reinvestment is actually going to pay off down the line.
Okay, now let's dive deep into Chapter 3, financial analysis. So what does this all mean for the bottom line? Let's look at the numbers.
Right. As of mid-June 2025, D-Wave's market capitalization is fluctuating, but it's somewhere in the range of about $4.83 billion to maybe $5.5 billion. That shows significant growth from late 2024 when it was around $1.91 billion. So the market value has shot up.
But what about earnings?
Well, they currently have a negative price to earnings, or PE, ratio. It's measured as 26.28. And that's simply a direct result of their consistent net losses. A negative PE just means the company isn't making a profit. There are no earnings to compare the price to.
Okay. How are their revenue growth trends looking then? Are those record sales we talked about sustainable?
Well, D-Wave has seen impressive top-line revenue growth, particularly in Q1 2025. They hit that record $15 million, which was that huge 509% year-over-year increase.
Driven by the one system sale.
Primarily, yes, driven by the initial sale of a single advantage quantum system. Now, they project full-year revenue for 2025 of $24.4 million, which would be 176% from 2024. Still strong growth projected. But, and it's a big one, but the reliance on these large, potentially infrequent system sales, it really raises significant questions about the consistency of future revenue growth and therefore sustained profitability. Can they keep landing these big deals regularly?
Makes sense. What about margins? That 92% gross margin sounded amazing.
It did, but again, context is key. While they achieved that remarkably high GAAP gross profit margin of 92.5% in Q1 2025, largely driven by that single system sale, their operating expenses also increased significantly, up 31% to $25.2 million. So this leads to persistent negative operating and net profit margins. Despite the high gross margin on that one sale, they still reported a net loss of $5.4 million in Q1 2025.
So still losing money overall.
Still losing money overall, yes. They're not profitable yet.
And what about debt and cash flow? Are they financially stable with all these capital raises? They have cash, right?
They do have cash now. Their debt-to-equity ratio improved significantly, down to 0.19 in Q1 2025 from 0.61 in Q4 2024. And that improvement is largely thanks to those recent equity raises, like the $146.2 million in Q1, and also using some funds to repay debt. They ended Q1 2025 with a record cash balance of $304.3 million. That's a solid cushion.
Okay, so cash is good, debt is down. Sounds positive.
On the surface, yes. However, and this is critical, despite this cash balance, D-Wave has consistently generated negative free cash flow. This means their actual day-to-day operations are consuming cash, not producing it. They're burning through money to run the business, which means they need ongoing external financing just to keep the lights on and fund R&D. So while the balance sheet looks better because of these cash infusions from investors selling new shares, their underlying core operations are not yet self-sustaining. That's the key financial challenge.
All right, let's turn our attention now to Chapter 4, market sentiment. How is the market actually perceiving all this?
Well, As you might guess, market perception of D-Wave is highly polarized and incredibly volatile. The stock has experienced these huge surging moments. I mean, a one-year return of nearly 1,300% as of mid-June 2025.
1,300%.
Incredible, right? It reflects significant excitement, maybe hype, around the future potential of quantum computing. The Advantage 2 at launch, for example, sent shares up almost 30% in a short period. However, this is constantly tempered by significant pullbacks and, frankly, deep skepticism. Often due to those concerns, we discussed revenue consistency, the reliance on infrequent system sales, the profitability questions.
How are analysts viewing this? It seems like a really complicated picture for them to assess.
It truly is. And the analyst view is quite telling, actually. The consensus price target among Wall Street analysts is currently $10.17.
Okay, $10.17, but where's the stock trading now?
Right. As of when we're recording this, the price is around $15.12. So the consensus target implies a substantial downside of about negative 3.75%.
Wait, a downside? But what's the rating? Usually targets are higher if they rated a buy.
Exactly. And that's the weird part. Despite that downside implied by the target price, the prevailing consensus rating among those same analysts is actually buy.
That doesn't make sense. A buy rating, but a price target way below the current price.
It's a clear disconnect. It's a bit of a red flag for you, the investor. It suggests that while analysts might believe in the long-term story enough to say buy, they also think the stock's rapid appreciation has way outpaced its fundamental valuation right now. They think the market has gotten ahead of itself.
Interesting signal. What's been the impact of recent news on this volatile sentiment?
News definitely moves the needle, sometimes dramatically. Those strong Q1 2025 results, they led to it means a significant chunk of the market, over 14%, is actively betting against the stock, that its price will fall. That's higher than its peer group average, indicating a strong bearish contingent. And the high options trading volume just further reflects this inherent volatility and the sharp divergence of opinion on where D-Wave is headed.
Okay. Moving on, let's explore Chapter 5. Ownership structure. Who actually owns D-Wave? And what does that tell us about investor confidence, maybe?
Good question. Institutional investors think big funds, pension plans, hold approximately 16% to maybe 32% of D-Wave's stock. Different sources give slightly different numbers, but it's in that range. This includes major players like BlackRock, Vanguard, Goldman Sachs.
So some big names are in.
Yes, but there's been quite dynamic movement within this group. Some large institutions have been increasing their stakes recently, but others, like the Public Sector Pension Investment Board of Canada, actually eliminated 100% of their shares in Q1 2025. They sold everything.
Wow, completely out.
Completely out. So it clearly indicates very divergent opinions, even among sophisticated institutional investors. Some are betting on it, others are heading for the exits.
What about insider holdings? People inside the company, what does that tell us, especially thinking about that Buffett-inspired skin-in-the-game idea?
Right, skin in the game. Insiders own approximately 1.89% to maybe 9.49% of the stock, again, depending on the source and calculation. It's not a huge percentage, but here's the critical part. Over the past 6 months, D-Wave insiders have engaged in 16 open market sales of their stock and 0 open market purchases.
16 sales, 0 buys from insiders.
Correct. This pattern of significant open market selling, particularly including sales by the CEO, Dr. Baratz, while it can easily be interpreted by you, the investor, as maybe a lack of strong conviction from those closest to the company, either in the stock's current high valuation or perhaps its near-term future prospects, it's generally not seen as a bullish signal.
Don't sound like it. Who owns the rest then?
The largest portion, around 74% or so, is owned by the public companies and individual retail investors like you listening. And having this higher percentage of retail and individual investors can often contribute to increased stock volatility, as retail sentiment can swing more quickly.
Makes sense. And what's the impact of their corporate governance structure, especially given those recent allegations we discussed?
Well, D-Wave has established corporate governance guidelines. They state they have a majority of independent directors on their board, they have a dedicated cybersecurity committee, things like that. Standard structures. However, the fact that there are ongoing legal investigations into potential securities fraud really suggests that despite these structures being in place, their actual effectiveness in upholding the highest standards of corporate conduct is, well, actively being tested right now. Public trust is definitely on the line.
Okay. Now 4. Chapter 6. Risk assessment, which we'll look at through a classic SWOT analysis: strengths, weaknesses, opportunities, and threats.
Sounds good. Let's start with the strength. Their pioneering technology and that dual architecture approach are key strengths. Also, their strong intellectual property portfolio, those 210 plus patents. Their focus on commercial viability today for real-world in-production applications is a differentiating factor. They've demonstrated quantum supremacy, albeit on specific problems. They have that robust Leap Cloud platform, and they have recently improved their cash position and debt-to-equity ratio, providing some financial runway.
Okay, those are the positives. But what about the weaknesses? There seem to be quite a few.
There are. Despite the impressive revenue growth figures in Q1, their persistent unprofitability and, crucially, that negative free cash flow are major weaknesses. Remember, they're consuming cash operationally. Their reliance on large, potentially infrequent system sales for those revenue spikes creates significant inconsistency and predictability issues. Operating expenses are high and rising, and significantly, the ongoing legal and reputational challenges stemming from those allegations of securities fraud and fundamental questions about their technology's credibility, they cast a very long shadow.
And the dilution.
Yes, and the fact that their necessary capital raises are consistently diluting existing shareholders is another key weakness from an investor standpoint.
Okay, now for opportunities. What's the upside potential look like? The biggest opportunity is simply the market itself. The rapidly growing quantum computing market, projected to hit over $7 billion by 2030. That offers immense potential across so many industries: AI, drug discovery, finance, material science. Significant government funding initiatives and potential government contracts are also major opportunities. And the increasing adoption of hybrid quantum classical solutions, where quantum works alongside traditional computers, also opens significant doors for companies like D-Wave. And finally, the threats they face. What could derail this?
Intense competition, number one. From those tech giants, IBM, Google, Microsoft, plus others like IonQ, Rigetti, it's a crowded field with deep pockets. The technological immaturity of quantum computing itself is a threat to everyone. Things like qubit fragility, the need for much better error correction. These are huge hurdles the whole industry faces. High barriers to entry, yes, but they also mean the existing players face huge ongoing costs and talent and R&D just to stay competitive. Then there are regulatory and geopolitical risks. Things like potential U.S. tariffs, maybe those discussed for 2025, could affect component costs or international market access. Export controls on sensitive tech are always a concern too.
And the perception issue.
Yes, and finally, that persistent market skepticism and the perception, particularly around quantum annealing being a niche or commercial dead end, that continues to threaten D-Wave's long-term growth narrative and valuation.
Okay. We've covered a lot. Let's bring it all together as we arrive at Chapter 7. Conclusion. What's the final verdict here?
Well, overall, D-Wave Quantum Inc. clearly operates in a frontier technology sector, one with absolutely immense long-term potential. You can't deny that. They are undeniably a pioneer, particularly in commercializing quantum annealing systems. They possess that substantial patent portfolio, which offers a foundational competitive advantage, at least for now. And recent financial results, like that record Q1 2025 revenue spike driven by the system sale, do show their ability to generate significant revenue from selling very advanced hardware.
However, if you're looking at this through a value investing perspective, like our Buffett lens, D-Wave isn't really a classic value play in the traditional sense, is it? It feels much more like a high-stakes bet on the future.
Exactly. It remains a highly speculative proposition rather than a stable, predictable investment. They are consistently unprofitable. They have negative free cash flow, meaning their operations consume more cash than they generate. That reliance on single, large system sales creates tremendous volatility and uncertainty about achieving consistent profitability.
Right, the path forward seems uncertain financially.
It does. And while their balance sheet has improved thanks to those recent equity raises, remember, those same raises dilute existing shareholders, making each existing share worth less of the company. They face that intense competition, the inherent technological immaturity in the whole quantum sector, and a complex, evolving regulatory environment. And crucially, those ongoing legal investigations into the credibility of their technology and management's ethical reputation, they introduce additional layers of pretty profound risk for investors.
So bottom line, all this suggests D-Wave Quantum is definitely a high-risk, potentially high-reward investment right now. A true speculative venture. It's really not the kind of predictable, stable company that a traditional value investor like Buffett typically seeks out. Now, let's not forget that looming cloud of potential U.S. tariffs in 2025, which could further squeeze their production costs and maybe their global reach, adding yet another layer of complexity to their already challenging path to profitability. So given this fascinating yet pretty turbulent landscape for D-Wave, how do you weigh the disruptive promise of quantum computing against these really significant financial, technological, and reputational risks? What questions does this deep dive spark for your own thinking about investing in the absolute cutting edge of technology? If you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to the Stock Analytics AI YouTube channel.
And remember, for just €429 a month, members get priority deep dives on the specific tickers you request. Plus, we also cover earnings calls in depth for members.
And as always, we have to give our important disclaimer.
Yes. This deep dive was generated by AI and is for informational purposes only. It is absolutely not financial advice. Investing in stocks, especially speculative ones like this, involves significant risks, and past performance is never indicative of future results. Readers and listeners should conduct their own thorough research and always consult with a qualified financial advisor before making any investment decisions.